A gold rush without gold, how thousands lost their money and their hopes for a better life. It began with certainty, not doubt. The claim was simple and repeated often. Vast wealth was waiting to be collected, not dug. No shovels, no rivers, no miners sleeping in mud. Just access, paperwork, and timing. The kind of opportunity that made risk feel optional. What mattered most was that the story arrived fully formed. It did not ask to be tested, it asked to be believed. At the center was a region described as untouched, underexplored, and quietly extraordinary. Reports spoke of deposits beyond historical comparison. The estimates circulated with confident precision, even though no independent survey had ever confirmed them. The language sounded technical enough to discourage questions and optimistic enough to invite money. The promise was not gold itself. The promise was proximity. Investors were told they did not need to own the resource. They only needed to own the right to it. Shares, concessions, future claims, these were presented as substitutes for physical proof. Paper replaced metal, and paper traveled faster. Early documents framed the opportunity as inevitable. The resource existed. Demand was global. The only missing piece, according to promoters, was capital to unlock it. Anyone entering early would benefit not from extraction, but from appreciation. Buy now, sell later. Let someone else do the hard work. This framing mattered. It shifted attention away from verification and toward momentum. No one was asked to confirm whether extraction was feasible. The question was whether others would buy in after them. Value was no longer anchored to what could be produced, but to what could be resold. The distinction was subtle but critical. Within months, financial instruments multiplied. Rights were bundled, subdivided, resold. New entities appeared whose sole purpose was to hold other entities' claims. Each layer added distance from the original source, but also added legitimacy. Complexity created comfort. The language evolved quickly. What began as exploration talk became investment strategy. Projections replaced measurements. Charts replaced samples. Meetings focused on price movement, not geology. When skeptics asked about timelines or costs, they were told those details were already priced in. Confidence became contagious. Newspapers played their role without coordination. Editors did not need instructions, they needed stories. And this one had everything: ambition, scale, national pride, and the suggestion that hesitation was a personal failure. Articles described fortunes forming quietly among those in the know. Silence became suspicious. Participation became proof of intelligence. Public figures added weight. Some invested, some merely endorsed. The distinction blurred in headlines. Their involvement was presented as validation, not conflict. If they believed, why shouldn't others? The market responded exactly as designed. Prices rose before any material change occurred. Each increase was treated as evidence that the underlying claims were real. Doubt weakened as numbers climbed. Skepticism was reframed as bitterness from those who had missed their chance. What made this moment dangerous was not deception alone, it was alignment. Promoters, investors, and commentators all benefited from the same outcome: continued belief. No one needed to fabricate data outright, they only needed to repeat what had already been said. The system rewarded reinforcement, not verification. There were warnings, but they were quiet and technical, buried in footnotes, delivered in language that did not travel well beyond specialists. And even those warnings often stopped short of denial. They questioned scale, not existence. Timing, not possibility. That was enough to be ignored. The structure ensured that early participants appeared brilliant. Their gains were real on paper. Their confidence visible. They spoke at events. They advised newcomers. Their success stories became marketing material even though nothing had yet been produced. The promise had matured into consensus. By the time most participants entered, the original claim no longer mattered. The system no longer depended on whether the resource could be extracted. It depended on whether confidence could be maintained. And for a while, it could. This was not a gold rush in the traditional sense. No one raced toward a physical location. The movement happened through documents, exchanges, and conversations. Wealth was pursued without contact with the thing that supposedly generated it. That distinction would prove decisive later, but at this stage it felt irrelevant, because the promise was not about what lay underground, it was about what lay ahead: returns, recognition, and the reassurance that belief itself was a form of due diligence. And that was enough to bring almost everyone in. The turning point was not when money arrived, it was when questions stopped. Once capital began to circulate, the system no longer needed persuasion, it needed repetition. The same assumptions, restated often enough, hardened into facts without ever being tested. What emerged next was a structure designed to move belief faster than evidence. At the base were the original claims, concessions, licenses, preliminary rights. Above them appeared holding companies, then trusts, then investment vehicles created specifically to own shares of other vehicles. Each step added legal distance from the source while increasing tradability. Ownership became abstract, but liquidity increased. This was not accidental. The architects understood that complexity protects narratives. When a structure is difficult to explain, it becomes difficult to challenge. Few investors could trace their stake back to a physical location, and fewer still tried. They were not buying land or material, they were buying participation in a system that rewarded entry. Financial instruments multiplied rapidly, options on future shares, notes tied to projected output, guarantees based on anticipated demand. None required extraction to function in the short term. All required confidence. Crucially, the market was designed to reward early motion, not long-term accuracy. Transactions occurred at a pace that discouraged inspection. Deals closed in days, sometimes hours. Prospectuses emphasized urgency. Language like limited window and closing tranche appeared repeatedly. Hesitation was framed as loss. Banks and intermediaries played a careful role. They did not verify the core claims. They verified documents. Signatures were valid. Entities existed. Payments cleared. This procedural legitimacy was mistaken for factual confirmation. Analysts followed price, not substance. Reports focused on market performance, not feasibility. Rising valuations were treated as validation of the underlying premise. The logic ran in reverse. If prices increased, something valuable must exist. No one asked whether the value came from expectation alone. Public commentary reinforced this loop. Articles cited other articles. Analysts referenced prior forecasts. Each source borrowed authority from another, creating the appearance of independent confirmation. In reality, the same assumptions circulated within a closed system. Dissent became inconvenient. Those who raised concerns were not disproven. They were sidelined. Their arguments were labeled overly technical, pessimistic, or misaligned with market sentiment. Some were accused of having ulterior motives, others were simply ignored. What mattered was momentum. Promoters emphasized scale over detail. The opportunity was always larger than any single objection. Even if one estimate proved optimistic, others remained. Even if timelines slipped, demand would grow. The story was elastic enough to absorb contradiction. Meanwhile, internal incentives discouraged correction. Executives were compensated in shares, not outcomes. Advisors were paid per transaction, not per result. Media benefited from audience interest. Every participant gained from continuation. The system rewarded affirmation at every level. Notably, physical verification lagged far behind financial activity. Site visits were rare and carefully managed. Data released to the public was summarized, not raw. Independent access was delayed for logistical reasons. These delays were framed as temporary obstacles, not red flags. Most investors accepted this without protest. They did not see themselves as buyers of a commodity. They saw themselves as participants in growth. Their focus was resale, not realization. This distinction allowed the mechanism to function without producing anything tangible. As long as new entrants arrived, earlier participants could exit profitably. Their success stories attracted more capital. Their exits were framed as strategic, not suspicious. Few asked why those closest to the source were selling. Regulatory oversight existed, but it moved slowly. Authorities reviewed compliance, not claims. As long as disclosures were made and procedures followed, intervention was limited. The absence of immediate enforcement was interpreted as approval. Confidence solidified further. By this stage, the system no longer depended on belief in a specific outcome. It depended on belief in the system itself. Participants trusted that someone, somewhere, had verified the core facts. No one felt responsible for doing it themselves. That assumption would later prove costly. But for now, the mechanism worked exactly as intended. Money moved, prices rose, participation expanded, and the distance between paper value and physical reality grew wider with each transaction. The more elaborate the structure became, the harder it was to see what, if anything, lay beneath it. The warning signs did not appear suddenly, they appeared quietly and then repeatedly. The earliest signal came from logistics, not geology. Delivery schedules slipped, equipment ordered months earlier remained unused. Contractors reported idle crews waiting for instructions that never arrived. None of this was alarming on its own. Delays were framed as coordination issues, common in large-scale ventures. What mattered was their pattern. By the time the third revision of the operational timeline circulated, internal documents no longer referenced specific milestones. Dates were replaced with phrases like subsequent phase and upon completion of preliminary assessments. Now, this shift was subtle but intentional. Precision creates accountability. Ambiguity absorbs failure. Technical reports began to change tone. Early assessments used definitive language. Later versions relied on probability. Words such as confirmed and verified gave way to indicated and potential. Footnotes expanded, assumptions multiplied. Each report remained positive, but the certainty eroded. Investors were unlikely to notice. Summaries emphasized continuity. Changes were buried in appendices few people read. Another signal came from staffing. Key specialists rotated out after short tenures. Their departures were described as routine or personal. Replacements arrived with impressive credentials, but narrower scopes of responsibility. No single expert oversaw the entire process anymore. Knowledge became compartmentalized, preventing anyone from forming a complete picture. This fragmentation was not accidental. When responsibility is distributed, accountability dissolves. Each participant can plausibly claim limited visibility. Decisions appear reasonable within isolated contexts, even when the overall direction makes little sense. Financial behavior offered further clues. Insiders began to restructure their holdings, not sell outright, but convert. Equity was exchanged for fixed compensation, consulting agreements, or deferred bonuses. These moves attracted little attention because they did not resemble panic, they resembled prudence. Publicly, confidence remained high. Announcements focused on partnerships and memoranda of understanding. These agreements signaled progress without committing to outcomes. Press releases cited interest, not output. Momentum was measured in meetings, not results. Meanwhile, verification stalled. Requests for independent audits were deferred. Access to primary data was restricted under confidentiality clauses. Third-party reviews relied on information provided by the same entities under review. This circular validation preserved appearances while avoiding scrutiny. Market response was muted. Prices fluctuated but held. Analysts interpreted stability as resilience. The absence of collapse was treated as confirmation that concerns were overblown. Few considered that a system built on expectation can remain stable long after reality diverges. Internally, a different picture emerged. Private correspondence revealed growing unease. Questions that once received prompt answers now generated explanations instead. Not denials, but narratives. Every issue had a reason. Every delay had context. Individually, they made sense. Collectively, they formed a pattern of avoidance. Yet no decisive action followed. Why would it? Incentives still aligned with continuation. Halting the process would crystallize losses. Proceeding allowed time, and time preserved optionality. As long as outcomes remained undefined, accountability could be postponed. This logic dominated decision-making. By the time regulators requested clarifications, responses were procedural, forms were complete, disclosures were updated. Nothing violated the letter of the rules. The absence of explicit fraud created a false sense of security. The system did not fail because no one noticed the signals. It persisted because noticing them required acting against self-interest. At this stage, the structure remained intact. Capital continued to circulate. Public confidence held. But beneath the surface, the gap between representation and reality had grown too large to ignore. The signals were clear. What was missing was the willingness to confront what they implied. The numbers looked impressive. That was the problem. Production forecasts rose quarter after quarter, even as on-site activity stalled. Projections doubled, then doubled again, without corresponding increases in verified output. On paper, the operation was accelerating. In reality, it was standing still. This contradiction went largely unchallenged because the metrics had changed. Early evaluations focused on extraction results. Later reports emphasized resource potential, future scalability, and comparative regional advantage. These were not false claims. They were irrelevant ones. Potential can expand indefinitely without ever becoming real. Executives learned to speak this language fluently. Presentations shifted away from tangible benchmarks toward models and simulations. Charts illustrated hypothetical yields under optimal conditions. Assumptions were stacked carefully, each reasonable on its own. Together, they produced outcomes that looked inevitable. They were not. What disappeared from public briefings were failure rates. Test sites that produced nothing were reclassified as non-representative. Equipment malfunctions were logged as environmental anomalies. Each explanation was technically valid. None addressed the core issue. The core issue was simple. Output remained negligible. Internal audits confirmed this, but those documents never reached investors. Instead, summaries were extracted and reframed. A line noting insufficient recoverable material became early-stage variability. Language softened conclusions without altering facts. This approach worked because complexity protects credibility. Most stakeholders lacked the technical background to challenge probabilistic models. Analysts relied on executive guidance. Journalists repeated press statements. Everyone assumed someone else had verified the details. No one had. Capital allocation followed the same logic. Funds earmarked for development were redirected toward exploration and infrastructure readiness. This created visible activity without requiring results. Roads were built, facilities expanded, staff increased. Progress was measured by spending, not success. This distinction mattered. A functioning operation generates returns. A speculative one generates motion. Motion can be mistaken for momentum, especially when supported by professional reporting and authoritative voices. Warning surfaced again, this time from mid-level managers. They flagged inconsistencies between reported estimates and field data. Their concerns were acknowledged, then absorbed into process reviews that produced no changes. Escalation paths existed, but they led nowhere. The structure rewarded compliance, not accuracy. At the same time, external validation was carefully curated. Consultants were hired to review methodology, not outcomes. Their endorsements focused on process integrity rather than results. This created the appearance of independent confirmation while avoiding substantive evaluation. Regulators requested updated disclosures. They received them. Nothing in those disclosures was false. Everything was incomplete. The system operated within legal boundaries, but outside practical reality. It relied on a shared assumption that eventual success would justify present ambiguity. As long as that belief held, the operation could continue indefinitely, but belief is not evidence. By this point, the discrepancy was no longer theoretical. Costs exceeded reasonable expectations. Timelines stretched beyond initial frameworks. Returns remained hypothetical. The model required constant optimism to survive, and optimism, once institutionalized, becomes resistant to correction. The venture had not yet collapsed. Public confidence persisted, but internally, decision-makers understood a critical truth they could not admit aloud. The metrics no longer measured reality. They measured hope. The first official review was supposed to end the speculation. Instead, it legitimized it. Oversight arrived not because alarms were ringing, but because scale demanded it. The venture had grown too large to remain informal. Capital exposure crossed thresholds that triggered mandatory reviews. Committees were assembled, procedures activated. On paper, accountability had arrived. In practice, nothing changed. The review focused on compliance, not performance. Auditors verified that disclosures followed regulations, that filings were submitted on time, that risk statements included appropriate disclaimers. All of this was true. None of it answered the only relevant question: was there gold in recoverable quantities? That question was never formally asked. Reports cited geological uncertainty, market volatility, and long-term horizons. These were standard caveats, widely accepted in resource ventures. They created a buffer between expectation and responsibility. As long as uncertainty existed, failure could be framed as delay. Executives understood this distinction well. They cooperated fully. Data rooms were opened, selected samples were shared, technical explanations were provided in detail. The process looked transparent because it was busy. Volume replaced clarity. Critical data sets were buried in appendices. Negative findings were contextualized until they lost meaning. Auditors, constrained by scope, did not challenge assumptions. They confirmed that assumptions existed. This was enough. Public summaries emphasized regulatory approval. Headlines followed. Investors interpreted oversight as validation. If authorities were involved, the thinking went, the fundamentals must be sound. That belief hardened. Meanwhile, internal cost structures shifted again. Operational spending slowed. Advisory spending increased. Legal teams expanded. Communication specialists were hired to manage perception. The enterprise began to resemble a financial instrument rather than a mining operation. This transformation was subtle but decisive. The original objective required extraction. The new objective required confidence. Confidence could be maintained without output, as long as documentation remained coherent and messaging consistent. Dissenting voices encountered procedural walls. Engineers who questioned feasibility were reminded of review cycles. Analysts who flagged mismatches were told to wait for updated models. Every concern had a process. Every process deferred resolution. Time became the primary asset. As long as timelines could be extended, the structure held. Projections were revised, not withdrawn. Milestones were redefined, not missed. Language adjusted faster than reality. Regulators returned for follow-ups. Each visit produced additional paperwork, additional assurances, additional compliance markers. None demanded proof of yield. The system rewarded form over substance. By now, capital dependency was complete. The venture could not scale down without triggering losses. It could not admit failure without legal consequences. Its survival depended on continuity, and continuity depended on silence. The oversight mechanisms designed to protect investors had been absorbed into the narrative. They no longer challenged the story. They became part of it. At this stage, the absence of gold was no longer the central risk. The real risk was that too many institutions had endorsed a process that no longer needed truth to function. The expansion began without evidence of success. That alone should have stopped it. Instead of increasing extraction, the venture increased territory. New claims were acquired. Additional sites were announced. Maps grew more detailed. Boundaries more ambitious. The narrative shifted from what we have to what we could control. Scale replaced substance. This move served two purposes. First, it diluted scrutiny. With multiple locations under evaluation, failure at any single site could be framed as part of a broader portfolio. Second, it reset expectations. Each new area came with its own timeline, its own uncertainty window, its own justification for patience. Investors accepted this logic because it sounded strategic. Expansion suggested confidence. Companies in trouble usually retreat. This one advanced. That signal mattered more than data. Internally, however, the decision was defensive. Existing sites had exhausted their explanatory value. Reports had been revised too many times. Test results were no longer ambiguous, they were repetitive. Expanding outward allowed management to avoid concluding inward. Operational teams were stretched thin. Equipment was relocated rather than upgraded. Personnel rotated between sites, generating activity without accumulation of results. Each location remained early stage, permanently one phase away from accountability. Budgets followed the same pattern. Funds were allocated for surveys, access roads, preliminary drilling. These expenditures produced invoices, photographs, and progress updates. They did not produce recoverable material, but they extended the story. Crucially, expansion also complicated comparison. Analysts could no longer track performance against a single benchmark. Metrics became averaged, normalized, and weighted. Underperformance at one site was offset by promise at another. The math worked. The reality did not. External partners were brought in selectively. Joint ventures spread financial exposure while reinforcing credibility. If multiple firms participated, risk appeared distributed. In practice, all relied on the same unverified assumptions. Shared belief replaced independent validation. The language of inevitability returned. Briefings emphasized regional potential, historical parallels, and technological evolution. The absence of gold was framed not as a result, but as a phase. Every phase implied the next one would be different. It never was. By now, operational truth and public narrative had fully diverged. Field data circulated quietly. Press releases grew louder. The gap between them widened without consequence. This imbalance could not correct itself. Expansion delayed reckoning, but it also increased dependency. More sites meant more capital, more commitments, more stakeholders invested in the outcome. Walking away became structurally impossible. The venture had crossed a threshold. It no longer needed to succeed. It only needed to continue. The shift did not start with panic. It started with silence. Trading volume thinned before prices moved. Long-term holders stopped adding. New investors hesitated. There was no headline, no scandal, no single trigger. The market simply became less willing to believe. This was the most dangerous phase. As long as enthusiasm exists, weakness can hide. When enthusiasm fades, even neutral information becomes suspect. Routine updates were reread. Language that once sounded confident now felt evasive. Analysts began asking questions they had previously ignored. Why had timelines been revised so often? Why did estimates grow while verified output stayed flat? Why did every explanation rely on future conditions? None of these questions accused fraud. They implied uncertainty. That was enough. The company responded with reassurance. Investor calls emphasized stability. Executives cited long-term vision and temporary headwinds. Slides repeated familiar arguments, but the tone had shifted. What once sounded assertive now sounded defensive. Markets detect tone. Short interest increased quietly, not dramatically, but consistently. It signaled skepticism without confrontation. At the same time, institutional investors reduced exposure without public comment. Their exits were gradual, designed not to disturb price. Retail investors did not notice at first. Public messaging still looked strong. Expansion plans remained active. Partnerships were intact. There was no visible collapse to react to, but the structure supporting valuation had weakened. Liquidity matters more than optimism. As capital inflows slowed, internal pressure intensified. Projects that depended on continuous funding faced delays. Contractors requested revised terms. Advisory costs rose as legal and communication risks increased. Cash flow became the limiting factor. Management adjusted again. Share buybacks were discussed, then postponed. Asset reclassification was proposed. Non-core holdings were listed as potential divestments. Each move aimed to preserve confidence rather than correct fundamentals. Meanwhile, discrepancies reached external observers. Independent analysts published cautious notes. They did not allege wrongdoing. They questioned assumptions. Their language was measured, but their impact was real. Trust erodes faster than it builds. The company countered with selective data releases. Positive samples were highlighted. Statistical outliers were framed as indicators. Context was minimized. These disclosures were accurate but incomplete, designed to stabilize perception rather than inform. The effect was temporary. Volatility increased. Small declines triggered larger reactions. Price movements no longer reflected news, but anxiety. The market had entered a feedback loop where doubt amplified itself. At this stage, the absence of gold was still not public knowledge. What was public was something more destabilizing, uncertainty without resolution. That condition cannot persist indefinitely. Sooner or later, ambiguity demands an answer. The story began to crack not in public, but on a server. An internal review, commissioned months earlier and quietly delayed, was finally completed. It was not dramatic. There were no accusations, no emotional language. Just tables, comparisons, and conclusions written in the restrained tone of professionals who knew exactly what their findings implied. Recoverable yield remained below minimum thresholds. Variance between projected and observed results was structural, not temporary. Further capital infusion would not materially change outcomes. These sentences never appeared in press releases. The document circulated among a narrow group of executives and legal advisors. Its distribution list was intentional. Engineers who had raised concerns earlier were excluded. Investor relations teams never saw the full version. What mattered now was containment. Management faced a constrained set of options. They could disclose the findings and trigger an immediate collapse. They could challenge the methodology and buy time, or they could reframe the conclusions without falsifying them. They chose the third. The report was summarized. Language was softened. Conclusions were reclassified as conservative scenarios. Risk disclosures were updated, but buried. The core message remained intact only for those who read beyond the executive summary. Most never did. What changed internally was behavior. Capital commitments slowed. Hiring freezes appeared without announcement. Certain expansion plans were paused indefinitely. These decisions were not explained externally, but they were noticed by partners and contractors. Silence again became a signal. At the same time, legal exposure was reassessed. Counsel evaluated disclosure obligations and timing. The question was no longer whether the venture would fail, but how that failure would be managed. Every action now carried precedent. Emails became cautious. Meetings were undocumented. Decisions were verbal. The organization entered a defensive posture, anticipating scrutiny that had not yet arrived but was now inevitable. Leaks were feared more than regulators. And then one occurred. A partial version of the internal findings reached an independent financial outlet. Not the full report, but enough to raise a specific question that could not be easily dismissed. Why did internal assessments contradict public optimism? The company denied inconsistency. They cited interpretation differences. They emphasized uncertainty. The outlet published anyway. The article was measured, not sensational. It did not claim fraud. It highlighted discrepancy. That was sufficient. Markets reacted immediately. Trading halted briefly due to volatility. Analyst calls intensified. Regulators requested clarification. The buffer of ambiguity collapsed in hours. What had been privately acknowledged was now publicly unavoidable. The venture still claimed potential. It still cited future scenarios, but for the first time, it was forced to respond to evidence rather than expectations. The gold question could no longer be deferred, and in the next stage, it would finally be answered. The moment oversight became unavoidable, speed replaced strategy. Within days of the publication, regulators issued formal inquiries. These were not accusations, they were requests for clarification, documentation, and reconciliation between internal assessments and public statements. On paper, the process was routine. In reality, it marked a point of no return. The company entered full response mode. Disclosure teams assembled parallel timelines. One set of documents showed compliance. Another explained interpretation. Lawyers reviewed every sentence for exposure. The objective was no longer persuasion, it was damage control. What regulators focused on was consistency. They compared early projections to later revisions. They tracked how assumptions evolved and whether those changes were disclosed with sufficient prominence. They examined whether risk language reflected internal knowledge at the time it was issued. This was not about gold yet, it was about disclosure integrity. Executives argued that uncertainty had always been communicated. They cited cautionary statements and forward-looking disclaimers. These defenses were technically sound, but they relied on a narrow definition of obligation. Regulators operate on a broader one. Internal correspondence became critical evidence. Emails referencing non-viable recovery and structural limitations were timestamped against optimistic public briefings issued weeks later. Individually, each message could be contextualized. Collectively, they formed a pattern. That pattern raised questions. Why had expansion continued after internal confidence declined? Why were new investors invited while internal funding was being restrained? Why did public optimism persist after internal conclusions shifted? The company's answers were procedural. Decisions, they said, were made in stages. Information evolved. Interpretations differed. No single moment justified reversal. This explanation was plausible but fragile. It depended on the absence of a clear breakpoint. Regulators searched for that breakpoint. They interviewed engineers, consultants, and mid-level managers. Some repeated official narratives. Others spoke cautiously, but confirmed a growing internal consensus that outcomes would not improve materially. None alleged deception. They described inertia. In parallel, financial consequences accelerated. Trading restrictions were imposed. Credit terms tightened. Counterparties demanded guarantees. Insurance premiums spiked. The cost of continuation rose sharply, while the possibility of recovery diminished. The venture was still operating, but it was no longer advancing. Public communication narrowed. Statements became shorter, more legalistic. Future projections disappeared. The narrative shifted from growth to review. Investors noticed the change immediately. Confidence, once eroded, does not stabilize. It collapses in stages. Each regulatory update, each delayed response, reinforced the same conclusion. The truth was closer than management had ever admitted, but one element was still missing. The investigations had not yet delivered a definitive technical judgment. The question of gold, actual, recoverable, measurable, remained officially unresolved. That resolution was coming, and when it arrived, it would not be negotiable. The final evaluation was not ordered to find gold, it was ordered to end doubt. Regulators authorized an independent technical assessment with a narrow mandate: verify recoverable yield using standardized methods, documented assumptions, and replicable sampling. No projections, no scenarios, no future technology, only what could be extracted under current conditions. This constraint changed everything. Previous assessments allowed interpretation. This one allowed measurement. The team selected sites based on reported potential, not convenience. Sampling locations were fixed in advance. Oversight observers were present at every stage. Chain of custody was enforced. There would be no flexibility. The company cooperated publicly and reluctantly. Refusal would have implied concealment. Participation implied risk. Management chose the lesser threat, aware that outcome control was no longer possible. Preparation revealed the truth before results did. Operational teams struggled to identify suitable sites. Areas highlighted in presentations lacked sufficient material for testing at required volumes. Equipment had to be moved repeatedly to meet protocol thresholds. These delays were logged. They mattered. When testing began, results arrived quickly, not because analysis was rushed, but because signals were clear. Concentration levels fell below commercial viability across samples. Variance was minimal. The data was consistent. Consistency eliminated hope. Attempts to contextualize followed immediately. Management pointed to geological complexity. They referenced long-term extraction strategies. They emphasized that resource ventures rarely succeed on first evaluation. The assessors rejected these arguments. Their report was explicit. Under present conditions and foreseeable adjustments, recoverable gold did not exist in quantities sufficient to justify continued investment. Further funding would increase losses without altering outcome. There was no ambiguity in the language. This time, the conclusion could not be reframed. The report was submitted simultaneously to regulators, auditors, and the board. Within hours, trading was halted, credit facilities were frozen, expansion agreements were suspended. The market reacted before the public statement was released. Internal discussion shifted from continuation to liability. Executives assessed exposure. Legal counsel prioritized disclosure timing. Communication teams prepared for final messaging, stripped of optimism. What followed was not chaos. It was administrative collapse. Projects were terminated in sequence. Contractors were notified. Assets were marked down. The structure unraveled according to process, not panic. The absence of gold was no longer speculative. It was documented. The collapse did not begin when the test failed. It began when the bills were added together. For years, the company reported losses as investments. Each deficit was framed as progress deferred. Each capital raise was justified by proximity to breakthrough. Shareholders accepted dilution because the narrative promised inevitability. Accounting transformed persistence into virtue. Internal records later showed a different pattern. Exploration expenses increased while measurable output remained flat. Logistics costs multiplied as sites expanded without yielding material returns. Executive compensation rose steadily, decoupled from operational performance. This was not hidden, it was normalized. Consulting fees formed a parallel economy. Geological reviews, strategic audits, and market studies repeated the same assumptions with new branding. Each report validated the previous one. None questioned the core premise. The cost of confirmation bias was measurable. Marketing expenditures exceeded field operations. Investor roadshows spanned continents. Visual models were refined quarterly. Projections grew more precise as evidence grew thinner. Precision replaced accuracy. Debt filled the gaps equity no longer could. Convertible notes delayed reckoning. Interest obligations were deferred, then capitalized, then reclassified. Complexity obscured fragility. Employees sensed instability long before disclosure. Hiring slowed. Internal transfers increased. Departures were framed as restructuring, not retreat. Severance agreements included confidentiality clauses. Silence was purchased cheaply. Suppliers absorbed risk by default. Payment terms stretched. Renegotiations became routine. Smaller contractors exited first. Larger ones stayed, confident that institutional backing implied solvency. It did not. By the time trading halted, cumulative expenditures exceeded any plausible recovery scenario. Even optimistic assumptions could not reconcile costs with potential yield. The enterprise required gold not to profit, but merely to survive. Still, the central question remained unanswered. How had so many professionals, regulators, and investors accepted a venture that never produced what it promised? The answer was not a single lie. It was a system that rewarded belief, punished doubt, and treated repetition as verification. The secret was not buried underground. It was buried in the reports everyone cited and almost no one read closely. The breakthrough never failed because it was never designed to succeed at scale. From the beginning, the geological model relied on selective sampling. Early core samples were taken from anomalous pockets, not representative formations. Those results were technically accurate and strategically misleading. They proved presence, not viability. Internal memos confirmed this distinction was understood early. Engineers flagged extraction limits within the first operational year. The concentration required for commercial recovery did not extend beyond isolated zones. Scaling would require processing volumes that exceeded available infrastructure and erased margins entirely. Management did not dispute the data, they reclassified it. The project was quietly redefined from extraction to resource validation. Timelines shifted, milestones were rewritten. What investors believed was production was, internally, perpetual testing. This allowed the illusion to persist. Each funding round was justified by a new objective that sounded final but was structurally unfinished. Pilot phase. Extended pilot. Optimization phase. Pre-commercial readiness. The gold was always one stage away. Regulatory filings revealed the core admission. In a footnote amended after initial submission, the company acknowledged that no extraction method tested to date demonstrated economic feasibility under prevailing market conditions. That sentence changed nothing publicly. Why? Because it came after the capital was raised. Executives did not lie about gold existing. They spoke truthfully about traces, indicators, and potential. What they omitted was intent. There was no plan to mine at scale. The business model depended on continued belief, not eventual delivery. The real product was access. Access to speculative upside. Access to a story that converted uncertainty into valuation. Access to a market trained to reward growth narratives over finished results. By the time independent auditors confirmed what internal teams already knew, the system was locked. Too many careers, funds, and reputations depended on momentum. Stopping meant admitting the truth. Continuing only required optimism. The gold rush had never been about gold. It was about sustaining the expectation that gold was coming, long enough to extract value elsewhere. The collapse did not begin with a scandal. It began with silence. Quarterly updates stopped mentioning timelines. Press releases lost verbs. What had once been framed as progress became review, then reassessment, then nothing at all. The market noticed before regulators did. The first visible crack was liquidity. When a scheduled capital raise failed to close, the company tapped bridge financing. That money covered payroll and consultants, not operations. Equipment leases were renegotiated. Field teams were reduced to caretakers. Extraction had quietly ended months earlier. Then came the filings. An amended annual report disclosed that impairment charges exceeded prior revenue by a factor of 12. The stated reason was revised assumptions regarding recoverable resources. Translated into plain language, the gold could not be mined profitably. It never could. Trading volume spiked as insiders exited under pre-existing plans. These sales were legal, disclosed, and devastating. Within weeks, the share price lost more than 90% of its peak value. No alarms were triggered. No emergency powers were invoked. This was not fraud in the cinematic sense. It was something more durable. The system worked as designed. Retail investors absorbed the losses. Pension funds wrote down exposure. Venture partners shifted to new narratives. The company entered restructuring, then liquidation without a single criminal charge. The assets sold for scrap. What remained were documents. Emails showed that the decisive moment came years earlier, when internal projections demonstrated negative returns even under optimistic pricing. At that point, the project could have been shut down with manageable losses. Instead, it was reframed. The belief was that time would solve the problem, that technology would improve, that markets would forgive delays. None of that mattered because the core assumption was false. The resource was insufficient. This was the gold rush without gold. The final accounting made the truth unavoidable. For every dollar invested in extraction, more than $2 had been extracted elsewhere. Through fees, stock appreciation, advisory contracts, and early exits, value was created, just not from the ground. No villains were unmasked. No heroes emerged. Only a pattern. Speculation did not fail because the gold was absent. It failed because belief replaced verification and momentum replaced math. The rush rewarded those who sold the promise early and punished those who waited for delivery. That is how the story ends. Not with an explosion or a trial, but with a balance sheet that finally told the truth. Years later, the story was no longer discussed as a failure of geology or management. It became a case study. Business schools reduced it to slides, timelines, charts, inflection points. Analysts debated valuation models. Lawyers cited it in memos about disclosure thresholds. The language was clinical, stripped of consequence. But outside classrooms and conference rooms, the effects were not abstract. Savings meant for retirement never recovered. Small funds closed quietly. Local contractors were paid late, then not at all. Careers built around a single promising project ended without notice. None of this violated policy. None of it required restitution. The episode left behind no monument, no abandoned mine, no environmental scar. That absence became its defining feature. Nothing physical marked the mistake. Only capital flows told the story. The lesson was not that speculation is dangerous. Speculation has always existed and always will. The lesson was subtler and more uncomfortable. Modern gold rushes rarely involve gold. They involve narratives that move faster than evidence, structures that reward optimism over verification, and systems where being early matters more than being right. Losses are socialized, gains are concentrated, and responsibility dissolves into process. After the collapse, new ventures emerged using different names, different technologies, different promises. Investors returned. Media coverage followed. The language sounded familiar. It always does, because the mechanism never disappeared. It simply waits for a new story strong enough to be believed. And that is why this was never just one company, one asset, or one moment in time. It was a reminder that when value is claimed before it is proven, someone eventually pays for the difference. The ledger always balances, just not where people are looking.